As the calendar turns to September 2025, the global economy stands at a crossroads, shadowed by whispers of an impending recession. The United States, the world's largest economy, is grappling with internal policy battles and external trade tensions, while nations worldwide brace for ripple effects. Recent events, including President Donald Trump's push for lower interest rates, met with Federal Reserve Chairman Jerome Powell's steadfast refusal, and escalating trade sanctions, particularly on China, have ignited fierce debate among financial analysts. History offers sobering lessons on recessions, from the Great Depression to the 2008 financial crisis, but today's complexities, driven by policy unpredictability and global interconnectedness, demand a fresh lens. This article delves into the question of whether a recession looms, analyzing historical patterns, current economic signals, global responses, and the role of emerging technologies. We explore three key areas: historical recession triggers, the impact of U.S. monetary and trade policies, and global trade dynamics in the face of sanctions. With a serious and introspective tone, we aim to unravel the risks and opportunities ahead, urging readers to reflect and act. Learning from history: what triggers recessions? Recessions are not random. They are often the offspring of excess, miscalculation, or external shocks. History reveals consistent patterns. The Great Depression of the 1930s, sparked by the 1929 stock market crash and exacerbated by protectionist policies like the Smoot-Hawley Tariff Act, saw global trade plummet by 65%, deepening economic despair. The 2008 financial crisis, rooted in unchecked housing market speculation and lax regulation, wiped out $2 trillion in global GDP. More recently, the 2020 pandemic-induced recession showcased how sudden disruptions, global lockdowns, supply chain breakdowns, can shrink economies overnight, with U.S. GDP contracting by 3.4% that year. Common triggers include asset bubbles, monetary policy missteps, and trade disruptions. Asset bubbles, like the dot-com bust of 2000, inflate valuations beyond fundamentals, leading to market corrections that erode wealth. Monetary tightening, as seen in the early 1980s under Paul Volcker's Fed, can choke growth to tame inflation, with unemployment peaking at 10.8%. Trade shocks, such as the 1973 oil embargo, spike costs and stifle demand. Today's environment echoes these risks. Stock markets down 10% from February 2025 highs, signal waning confidence, while tariffs threaten supply chains. Yet history also offers hope. Economies recover when policymakers adapt. Think Roosevelt's New Deal or the Fed's swift rate cuts in 2020. The lesson? Proactive, data-driven decisions can mitigate damage. Current indicators are mixed. U.S. consumer sentiment dropped for 3 consecutive months through March 2025, with inflation fears rising, yet job growth remains resilient, adding 228,000 positions in March. The Federal Reserve Bank of Atlanta's GDP Now tracker, however, projects a 2.4% contraction for Q1 2025, hinting at trouble. Chart: historical U.S. recession indicators, selected periods. Call to action: reflect on your financial resilience. Are you prepared for economic turbulence? Diversify investments and build an emergency fund now. Share your strategies in the comments below to inspire others. U.S. policy battles, Trump, Powell, and economic uncertainty. The U.S. economy, once hailed as a beacon of exceptionalism, is now a battleground of conflicting visions. President Trump's aggressive push for lower interest rates clashes with Federal Reserve Chairman Jerome Powell's cautious stance, creating a policy maelstrom that unnerves markets. Trump, branding Powell too late and a major loser, argues that high rates, currently at 4.25 to 4.50%, stifle growth, especially as tariffs raise costs. In April 2025, he demanded immediate rate cuts, citing declining energy prices and low inflation, which he claimed was virtually non-existent. Powell, however, remains unmoved, emphasizing the Fed's independence and warning that tariffs could fuel inflation and slow growth. In a March 2025 speech, he noted that the economy remains in a good place, but faces elevated risks from trade policies, with no rate cuts planned until at least December. Financial analysts are divided. Goldman Sachs raised recession odds to 45% in April 25, citing tariffs and declining business confidence, while JP Morgan slashed its 2025 growth forecast to 0.5% from 2.8% in 2020. Others, like T.S. Lombard's Stephen Blitz, argue that resilient job data suggests growth, not collapse, though capital spending could falter. CEOs surveyed by CNBC in April overwhelmingly predict a recession, with 69% expecting a downturn by year-end, driven by tariff-induced price hikes and job cuts. Walmart's CEO warned Trump of supply chain disruptions, projecting bare shelves by summer if tariffs persist. Trump's tariff policies, including a 10% baseline on all imports and a 145% levy on China, have sparked market turmoil. The S&P 500 lost $2.4 trillion in a single day in April 2025, its worst since March 2020. The U.S. dollar, down 9% in 2025, faces its steepest monthly decline since 2007, undermining its safe haven status. Yet, Trump's partial retreat, a 90-day pause on most tariffs except China's, sparked a market rebound, with the Dow gaining 420 points on April 23. This volatility underscores the uncertainty Powell refuses to exacerbate with premature rate cuts. Want to stay ahead of economic shifts? Subscribe to our newsletter for weekly insights on markets, policies, and personal finance strategies. Don't let uncertainty catch you off guard. Join now. Global trade and sanctions. A world on edge. The global economy, intricately linked, faces a storm of trade sanctions and retaliatory measures. Trump's tariffs, announced as a Liberation Day on April 2, 2025, imposed a 10% duty on all U.S. imports, with targeted levies on China, 145%, Japan, 24%, and the EU, 20%. Canada and Mexico face 25% tariffs on many goods, though a one-month USMCA reprieve offers temporary relief. China retaliated with 34% tariffs on U.S. goods, wiping $5 trillion off global stock markets. The EU, Japan, and others are holding off on retaliation, seeking negotiations, but the World Trade Organization forecasts a decline in global trade volume for 2025, with JP Morgan estimating a 0.7% net drag on global GDP. Other nations are navigating this turmoil with varied strategies. The European Central Bank cut rates to 2.25% in April 2025, citing exceptional uncertainty from U.S. tariffs, aiming to spur growth. China, facing a 0.3% trade-related growth hit, plans 1 trillion yuan in bond issuance to bolster domestic demand. The UK, less exposed, expects a modest 0.2% GDP hit, cushioned by government spending, though tax hikes loom if growth falters. Emerging markets like Mexico and Canada face recession risks, with growth forecasts slashed to 0.2% and 1.2%, respectively. Sanctions amplify the strain. Trump's tariffs on China, targeting electronics and low-value packages, aim to curb its trade dominance but risk stagflation, low growth paired with high inflation. Retailers like Nike and Apple, reliant on Asian supply chains, face profit squeezes. Globally, countries are imposing counter tariffs to protect markets, with the EU pausing countermeasures to negotiate. The IMF, while optimistic about avoiding a global recession, warns of subpar growth, projecting global GDP at 1.4% in Q4 2025, down from 2.1% earlier. Chart: Global GDP Growth Forecasts, 2025. Technology and Trends, Navigating the New Normal. Emerging technologies offer tools to weather economic uncertainty. AI-driven financial platforms, like Wealthfront or Betterment, help consumers optimize investments amid market volatility, with 62% of millennials using such tools in 2025. Blockchain-based supply chain solutions, adopted by 15% of global retailers, enhance transparency, mitigating tariff-induced disruptions. Social media platforms, like X, amplify consumer sentiment, with posts reflecting recession fears driving 20% of investment decisions in Q2 2025. Yet, technology also amplifies risks. AI trading algorithms, responsible for 70% of market trades, can exacerbate sell-offs, as seen in the April 2025 market plunge. Cybersecurity threats loom as firms digitize, with ransomware attacks on retailers up 30% this year. Consumers must stay vigilant, using secure platforms and diversifying digital assets. Call to action. Leverage AI tools to track your finances and explore blockchain for supply chain insights. What tech are you using to stay financially resilient? Share your tips below. Facing the future with clarity. History warns that recessions stem from hubris, policy missteps, or external shocks, and 2025 bears these hallmarks. Trump's tariff-driven trade war and his clash with Powell's Fed signal a rocky road, with 45 to 60% recession odds per top analysts. Global responses, from China's bond issuance to Europe's rate cuts, reflect a world scrambling to adapt. Yet technology and prudent planning offer lifelines. As markets gyrate and trade tensions simmer, the past urges preparedness over panic. Build your financial fortress, monitor global trends, and act decisively. Final call to action. Are you ready for what's next? Stress test your budget, explore AI-driven financial tools, and join the conversation below. How are you preparing for economic uncertainty? Let's learn from history and shape a stronger future together.